Hello and welcome back to Money Talks, your guide to the Canadian securities. I'm your host, Rita, and it's so wonderful to have you with us again. A huge thank you to our returning listeners for your incredible support. And if you're new here, welcome. We're thrilled to have you. If you find today's episode helpful, please consider taking a moment to subscribe, like, and leave a comment. Sharing it with a friend or colleague helps us immensely in our mission to develop valuable content that empowers people in their financial education and careers right here in Canada. Now, let's get into it. I'm joined once again by the brilliant Jonathan Cartier. Hey, Jonathan, great to have you back on the show. How's everything going in the market?
Hi, Rita. Thanks for having me. The market is, well, it's being the market, always keeping us on our toes. But that's why understanding the fundamentals is so crucial, no matter which way the winds are blowing.
So true. And speaking of fundamentals, that brings us perfectly to our topic. Today, I want to pull back the curtain on something most Canadians have heard of, maybe even own, but might not fully grasp: mutual funds. Talk about the importance of understanding their structure and the regulations that govern them.
Absolutely. This is foundational stuff. Knowing this is like knowing the blueprints and the building codes for your house. It ensures you know what you're buying and that it's built on a solid, safe foundation.
Great analogy. So where do we start? Before we even get to mutual funds, I see the term managed products a lot. What does that mean?
Think of a managed product as a financial potluck dinner. Instead of everyone bringing a dish, a group of investors pools their money together. Then a professional chef, the investment manager, takes that pool of money and buys all the ingredients, or in our case, securities like stocks and bonds, according to a specific recipe, which is the investment mandate.
A potluck. I love that. So what kind of recipes can this chef follow?
There are two main cooking styles. First, there's active management. This is where the chef gets creative. They use their expertise and research to pick specific ingredients they believe will create a dish that's better than the average restaurant. They're trying to outperform a market benchmark, like the S&P TSX 60. Then there's passive management. Here, the chef isn't trying to invent a new dish. They're meticulously following a well-known recipe to replicate it perfectly. A common example is an index fund that just buys all the stocks in the TSX 60 to mirror its performance. It's less about picking winners and more about capturing the market's overall return.
That makes perfect sense. So for the average person who doesn't have time to be a financial chef, what are the biggest advantages of joining this potluck?
The benefits are huge, Rita. First is professional management. You're hiring that expert chef for a fraction of what it would cost to hire them privately. Second is diversification. With just a small amount of money, say $100, you can instantly own a piece of dozens, even hundreds of different companies. Trying to buy all those stocks individually would be incredibly expensive and complicated. Think of it as getting a full tasting menu for the price of an appetizer. And finally, there are economies of scale. The fund buys and sells in huge volumes, so transaction costs are much lower, and those savings get passed on to you.
Okay, so a mutual fund is one of the most popular types of these managed products. How are they actually built? I hear terms like trusts and corporations.
Right. The structure is the legal container for the fund. The most common structure in Canada is the open-end trust. Imagine a community garden. You buy a plot, which is a unit in the fund. The garden itself, the trust, doesn't pay taxes. Instead, all the fruits and vegetables it produces, the dividends, interest, and capital gains, flow directly through to you, the plot owner. You then report that income on your own tax return. It's very efficient structure.
A community garden. Brilliant. It really helps visualize that flow-through concept. And who are the key people running this garden?
There are three main roles. You have the fund manager, who is the head gardener. They make the daily decisions: what to plant, when to harvest, what to sell. They're the brains of the operation. Then you have the custodian. This is usually a large trust company or bank. Think of them as the person with the keys to the tool shed and the bank vault. They hold all the fund's assets, the cash and securities, safely and independently. And finally, the distributor. These are the people who sell the plots in the garden to investors. They could be investment advisors at a big firm or a salesperson at your local bank branch.
A community garden. Brilliant. It really helps visualize that flow through concept. And who are the key people running this garden?
There are three main roles. You have the fund manager, who is the head gardener. They make the daily decisions, what to plant, when to harvest, what to sell. They're the brains of the operation. Then you have the custodian. This is usually a large trust company or bank. Think of them as the person with the keys to the tool shed and the bank vault. They hold all the fund's assets, the cash and securities, safely and independently. And finally, the distributor. These are the people who sell the plots in the garden to investors. They could be investment advisors at a big firm or a salesperson at your local bank branch.
I think this is especially relevant to our listeners. A lot of them may have their money managed, but they may not know the full scope of the players that make it happen. Jonathan, that's a fantastic way to visualize the entire ecosystem. And for our listeners, if you're finding these analogies helpful and this information valuable, this is the perfect time to pause and hit that subscribe or follow button. You can find Money Talks on Spotify, Apple Podcasts, YouTube, Podbean, Audible, and wherever else you get your podcasts. Sharing this episode with a friend who's just starting their investment journey is one of the best ways to support the show. All right, Jonathan, we have our potluck and our community garden, but this involves people's life savings, so there must be strict rules. Let's talk about regulation.
This is the most critical part, Rita. It's all about investor protection. In Canada, the industry is regulated by provincial securities commissions, with national rules that apply across the country. The two big ones are National Instrument 81-101 and 81-102, which govern disclosure and sales practices. The single most important document for an investor is the fund facts document.
Okay, break that down for us. What is it?
The fund facts is like the mandatory nutritional label on food. It's a short, easy-to-read, two-page summary that tells you everything you need to know before you buy. It lists the top 10 ingredients, the fund's biggest investments, the risk rating on a simple scale from low to high, its past performance, and crucially, the cost. And here's the key rule. A dealer must give you the fund facts document before you purchase the fund. It's not optional. It's your right as an investor.
That's so important. And part of that protection, I assume, is the famous Know Your Client or KYC rule. Why is that so fundamental?
Exactly. The Know Your Client rule is our allergy check before we serve you the meal. Before a financial professional can recommend any investment, they are legally required to understand your personal situation, your financial goals, your investment timeline, and your comfort level with risk, both your willingness to take risk and your financial capacity to handle it. We can't recommend a spicy, high-risk emerging markets fund to a retiree who needs stable income. It's our primary duty to ensure the investment is suitable for you. If an investor refuses to provide this information, we simply cannot proceed with the transaction. It's the law, and it's there to protect them.
That brings us to the final and maybe most talked about piece of the puzzle, the cost. How do investors pay for all this professional management and oversight?
The primary cost is the management expense ratio, or MER. This is the big one. It's an annual fee expressed as a percentage of the fund's assets that covers all the operational costs, the fund manager's salary, admin, legal fees, and the trailer fee paid to your advisor for ongoing service. For example, if a fund has an MER of 2%, it means for every $1,000 you have invested, about $20 per year goes towards running the fund. The key thing to remember is that you don't get a bill for the MER. It's taken directly out of the fund's assets, so the performance you see reported is always after this fee has been deducted. It's crucial to compare MERs when you're comparing similar funds.
Wow, we've covered so much ground. Managed products, the structure of funds, the key players, and the vital regulations like fund facts and KYC that protect investors. So, as a final thought for our listeners, the next time you look at your own investment statements, maybe ask yourself, do I have the fun facts for my funds? Do I understand their risk level and their MER? Jonathan, thank you so much for breaking this down with such clear, powerful analogies.
My pleasure. Rita, the final piece of advice is simple. Always read the fun facts. It's short, it's clear, and it's your best friend in understanding exactly what you're buying into.
Perfect advice to end on. And that's all the time we have for today on Money Talks. A big thank you to Jonathan Cartier for his expertise and to all of you for tuning in. Don't forget to subscribe so you don't miss our next episode, where we'll be diving into the different types of mutual funds. Until then, stay curious and invest wisely.